Hello everyone, welcome back to my channel, The Tax Master UAE. Today we are going to learn the most recent notifications or guidelines issued by the Federal Tax Authority regarding the tax treatment of family foundations. So in this video, I have explained the meaning of family foundation, what is its conditions, and what can be the legal structure for that family foundation, and then the tax treatment for such family foundations. So without any delay, let's get it started. First of all, what is a family foundation? So family foundation is a legal structure that many families use to manage, protect, and pass on wealth from one generation to another generations in an organized, or you can say tax efficient way. So family foundation for corporate tax purposes can be any foundation, trust, or similar entities that meet the condition which are specified in Article 17, Sub-Article 1 of the Corporate Tax Law. The first conditions is that, therefore we can say there are two conditions. One, it should be trust, foundation, or similar entities, and another condition is that it should meet the criteria specified in Article 17, Sub-Article 1 of the Corporate Tax Law. Now we'll move to first condition. That means it should be trust, foundation, or similar entities. Here one thing to note is that there is no requirement for family foundation to be an entity formed only in UAE. It means it is possible for a foreign companies, non-UAE entity, to be a family foundation if they meet the condition of family foundations. The second conditions are Article 17 sub 1 of the Corporate Tax Law specifies certain criteria that need to be met by the trust, foundation, or similar entities to qualify as a family foundation. Number one criteria is beneficiary condition. The family foundation should be established only for the benefit of identified or identifiable natural person. Here identified means the beneficiary whose name is mentioned in the legal document of the family foundations. And identifiable natural person means, suppose Mr. A is the beneficiary of any foundations. His name is specifically mentioned in the article, or you can say MOA article of that trust. Then he will be regarded as an identified natural person. Suppose he has a child or he has a grandchild whose name is not specifically mentioned in that document, but after Mr. A, who is going to receive that money? His children or grandchildren. So in this case, his children or grandchildren whose name is not specifically mentioned in the document will be regarded as identifiable natural person. So the family foundation should be established only for the benefit of that beneficiary, family member of the beneficiaries, or public benefit entities. It means the entities or organization which works for the betterment of needy people. The second condition is that principal activity condition. Here the main objective, the main principle of the family foundation should be only to receive assets, hold them for a long period of time, invest them, and then manage the family savings and wealth. Except that no any conditions, no any activities should be conducted by family foundations. The third condition is that no business activities condition. It means the family foundation is established just to hold family assets like properties, shares, or bank savings, and not running a business to earn the profit. Fourth condition, no tax avoidance condition. It means the family foundation is formed mainly to manage family wealth, plan inheritance, or support charitable causes, not to escape or reduce the tax liability. And the last and not the least is distribution condition. So distribution condition means whatever family foundation earns or hold any property, money or benefit, that money, property or benefits will be distributed to the beneficiaries, family member of the beneficiaries, or charities or public welfare organizations, also known as public benefit entities, like registered educational charity, hospital or relief fund. So or if any foundation, trust or similar entity fulfill these criteria, then they will be regarded as family foundations. Now we'll understand its legal corporate structure, then we'll go to tax treatment. So look, any foundation, trust or similar entity, if they meet the condition mentioned in Article 17, sub-article 1 of the corporate tax, they will be regarded as family foundation. Now that family foundations, the beneficiary family foundation can be either a person having a separate legal entity or a person having not a separate legal entities. Now let's come to a person, a beneficiary who does not have separate legal entities. So any person, any beneficiary which does not have separate legal entities, in that case it will be regarded as, such beneficiary foundation will be regarded as unincorporated partnership for corporate tax purposes. And where a family foundation will be regarded as unincorporated partnership, it is considered to be fiscally transparent and hence are not subject to corporate tax in its own right. It means when a family foundation is established or beneficiary of family foundation is natural person, you can say, which does not have separate legal personality, in that case that family foundation will be treated as unincorporated partnership, and unincorporated partnership by default is treated as fiscally transparent and are not subject to corporate tax in its own right. Instead, each partner will be treated as conducting the business of the unincorporated partnership and are subject to corporate tax on its share of assets, liabilities, income or expenditure in the unincorporated partnership. Therefore, it's the partner that must consider their corporate tax positions in the UAE. Now let's come to beneficiaries of the family foundation which has separate legal personalities. So if the beneficiary has separate legal personality, in that case it will be regarded as juridical person for corporate tax purposes, and by default juridical person are subject to corporate tax in the UAE. But if that juridical person meet the condition specified in Article 17 sub Article 1, then they will be treated as family foundation, and once they are treated as family foundation, they can apply to FTA, they can make an application to FTA to treat that as unincorporated partnership. And if FTA approved, in that case the family foundation will be treated as fiscally transparent unincorporated partnership, and in that case it will not be subject to corporate tax in its own right. Instead each partner will be subject to corporate tax, similar to the beneficiary which does not have separate legal personalities. To sum up, to conclude, just remember family foundation, who are the beneficiaries. Number one, any person having separate legal entities and personalities or not separate legal personality. If not legal separate personality, like natural person, in that case it will be the family foundation will be treated as unincorporated partnership, where each partners are taxable, not the family foundation. If the beneficiaries has separate legal personality, it will be regarded as juridical person, and a juridical person by default are subject to corporate tax in the UAE. But if they meet the condition under Article 17 sub Article 1, in that case it can make an application to Federal Tax Authority to make the family foundation fiscally transparent. In that case, again family foundation will not be subject to corporate tax. Instead, each partner will be subject to corporate tax. This is all for today. Hope you understood the concept and its tax treatment. If you have any questions or doubts, please mention in the comment section. Thank you so much.